once again this press briefing. The MPC has held its 55th meeting, during which the committee reviewed the latest economic developments, and we present to you highlights of the deliberations and subsequent positioning of the policy rate. First, I start with global developments. Global economic conditions improved following the implementations of various policy measures that successfully contained the threat of the euro area breakup and fiscal contraction in the USA. Overall, global growth remained constrained, leading to downward revisions of end-year output forecasts from 3.5% to 3.3% in April 2013. However, the growth is at a multi-speed mode, with emerging and developing countries expected to drive the growth at 5.3%. The USA is expected to grow at 1.9%, while the euro area will contract by 0.3%. Global inflation was largely subdued, having declined to 3.5% from 3.8% at end 2012, and is projected to remain around this level through 2014. Inflation is expected to increase further from about 2% to ease further from about 2% to 1.8% in the USA, and from 2.3% to 1.5% in the euro area. In emerging markets and developing economies, inflation pressures are likely to remain contained, supported by a recent slowdown in food and energy prices. International commodity prices broadly softened in the first quarter of 2013. Crude oil prices ended the first quarter at $112.56 per barrel and are projected to end the year at $100 per barrel. Gold prices have declined sharply to $1,400 per ounce as of 21st May, that's yesterday, and are forecast to rise only slightly to $1,455 per ounce by year end. However, cocoa prices were at $2,176 per ton in the first quarter, and is expected to end the year at about $2,475 per ounce. Domestic developments, inflation and growth. Headline inflation for April 2013 was 10.6%, up from 10.4% in March and 8.8% in January. The upward movement in inflation is partly explained by the continued effect of the downward adjustment of petroleum prices upward adjustment of petroleum prices in February, coupled with seasonal effects. Food inflation rose to 6.4% in April from 3.5% in January, while non-food inflation edged up to 13% from 11.5% in the same period. The bank's Composite Index of Economic Activity, the CIA, which measures the pace of economic activity, contracted by 0.6% in March 2013, against a 14.8% growth in March 2012. All the components of the CIA recorded negative real growth, with the exception of tourist arrivals, domestic VAT, and DMB's credit to the private sector. The latest surveys conducted in March and April by the Bank of Ghana showed weakened sentiments by both businesses and consumers. The Business Confidence Index declined to 99% in March 2003 from 104.1 in December 2012. This was partly due to the energy crisis, which in turn lowered business optimism about growth prospects and heightened inflation expectations over the medium-term horizon. Similarly, the Consumer Confidence Index also fell to 96.1 in April from 105 in January 2013. Government fiscal operations for January to April 2013. Provisional estimates on broad fiscal data show that for the first 4 months of the year, government fiscal deficit was equivalent to 3.8% of GDP against a target of 3%. This outturn was on the back of a significant shortfall in revenues, with expenditures marginally below target. Total revenue and grants was 6.3 billion against a target of 7.1 billion. Of this outturn, domestic revenue amounted to 5.9 billion, below the target of 6.4 billion on account of lower tax revenues. Total tax revenue amounted to 4.2 billion, below the target of 4.9 billion. The low tax revenue collection over the period was the result of lower company profits and lower imports due to the general slowdown in economic activity. Grant disbursements also fell short of target by 38.3%, reflecting non-disbursement from multi-donor budget support, that MPC partners. Non-tax revenues, on the other hand, turned in higher than budgeted at 1.6 billion compared to the target of 1.5 billion. Total expenditures, including payments for the clearance of arrears and outstanding commitments, amounted to 9.7 billion, lower than the budget of 9.8 billion. The wage bill amounted to 3 billion against a target of 2.8 billion. Similarly, interest payments amounted to 1.6 billion against a target of 1.1 billion. These developments resulted in an overall budget deficit of 3.4 billion in the first 4 months of the year against a target of 2.7 billion. The deficit was financed mainly from domestic sources, resulting in a net domestic financing of 2.7 billion, higher than the target of 2.2 billion. Foreign financing of the budget amounted to 687.2 million, also higher than the target of 482.1 million cedis. The stock of public debt increased to 38.3 billion Ghana cedis, or 43.2% of GDP, that's of 2013 GDP, at end April 2013, from 35.1 billion in December 2012. Of this, the stock of domestic debt amounted to 20.3 billion cedis compared to 18.5 billion cedis in December 2012. External debt stood at $9.5 billion, up from $8.8 billion over the same period. Monetary and banking sector developments. The pace of expansion in monetary aggregates moderated in the first quarter of 2013. Broad money grew by 24.1% in March 2013 compared with 29.1% in the same period a year earlier. This was largely driven by a sharp drop in the annual growth of foreign currency deposits to 14.1% in March 2013 from 47.7% in March 2012. The latest Bank of Ghana Credit Conditions Survey showed a general net tightening of credit conditions with the exception of consumer credit, which saw some easing. The credit stance for all other loan types, including SMEs, large enterprises, short and long-term loans, were tightened in the period. Annual growth in the private sector credit slowed to 28.7% in nominal terms at end of March 2013 from 44.6% in March 2012. Similarly, the annual growth for real private sector credit was 17.6% in March 2013, down from 32.9% in March 2012. Banking sector performance was strong in the first 4 months of the year, with increased competition, asset growth, improved liquidity and profitability. Total assets of the banking industry increased to 29.6 billion cedis at the end of April 2013, compared with 23.2 billion cedis in April 2012. This was driven mainly by advances, which accounted for 42.5% of the total. The asset growth was funded by deposits, which recorded an annual growth of 22.4% to 20.7 billion at the end of April 2013. Non-performing loans. The non-performing loans ratio within the banking industry decreased to 13.3% in April 2013 from 14.1% in April 2012, while the ratio excluding the loss category declined to 5.2% from 6.1% during the same period. Interest rates on the treasury bill market have broadly declined. Between December 2012 and April 2013, both the 31-day and 182-day treasury bill rates remain broadly unchanged at 23%. The 1-year note rate fell from 23 to 22.1%, while the rate on the 2-year note declined from 23 to 22.4%. The 3-year bond rate fell from 21 to 16.9%. There was no issue of the 5-year bond during the period. Therefore, the rate remained unchanged at 23%. The weighted average interbank rate declined to 16.9% in April 2013 from 17.5% in December 2012. Average lending rates of banks were revised upwards to 27.1% in April 2013 from 25.7% in December 2012. The average rate on 3-month deposits remained stable around 12.3%, resulting in a wider spread of 14.8% in April 2013 compared with a spread of 13.2% in April 2012. External sector developments. The current account recorded a deficit of $1.1 billion in the first quarter of 2013 compared to a deficit of $986.6 million in the same period of 2012. This was reflected in all its components. The trade deficit worsened to $334.6 million in the review period from a near zero balance in the corresponding period of 2012. The services, income and transfer accounts recorded a lower deficit of $788 million compared with a deficit of $986.8 million in 2012. The outturn for the trade account was driven by some moderation in the prices of major export commodities on the international market and slower growth in imports. Total exports declined by 7.3% in year-on-year terms to $3.8 billion during the first quarter of 2013. Of the total increase, gold exports were $1.5 billion, cocoa beans and products were $725.8 million, while crude oil exports amounted to $1.1 billion. Total imports, on the other hand, recorded a marginal year-on-year growth of 0.8% to $4.2 billion in the first quarter. Of this, non-oil imports went down by 7.8% to $3.2 billion, while oil imports increased by 44.2% to $913.3 million. The net flows into the capital and financial account improved to $1.4 billion compared with $156.7 million in 2012. This was on the back of higher official capital inflows amounting to $316.3 million, net short-term capital flows of $262 million, portfolio investments of $246.3 million, and private capital of $570 million. These developments resulted in an improved balance of payment deficit of $136.3 million in the first quarter of 2013, compared with a deficit of $1.3 billion in the same period of 2012. In the period January to mid-May 2013, the Ghana cedi cumulatively depreciated by 2.3% against the US dollar. During the first quarter of 2013, however, the real exchange rate appreciated by 5.9%. Private inward transfers received through the banking system from January to March 2013 declined by 14.1% on a year-on-year basis to $3.9 billion. Of the total transfers, $393.2 million accrued to individuals compared with $478.5 million in the same period of 2012. Gross international reserves amounted to $5.2 billion at the end of April 2013 compared to a stock position of $5.4 billion at the end of December 2012. This is equivalent to 2.9 months of import cover. Summary and outlook. In summary, the committee has noted the continued vulnerabilities in the global economy, despite some modest gains in economic conditions. In particular, the weakening of commodity prices on the international market has increased the risk to the external outlook. The committee observed challenging domestic economic conditions in the first 4 months. Specifically, the pace of growth in economic activity has weakened, evidenced by contraction in the CIA. Business and consumer sentiments on growth prospects have softened amid heightened inflation expectations. The pace of growth in credit to the private sector has also moderated, while the credit stance of banks has tightened. On the external front, the trade deficit has widened further on the back of a significant deterioration in the terms of trade. This was on account of low international commodity prices, which have fed through to lower export receipts despite imports remaining broadly flat. The combination of these factors have resulted in heightened exchange rate pressures in the foreign exchange market, although at a measured pace relative to 2012. Inflation has also gone up for the third consecutive month, raising the central part of the forecast by 1 percentage point. The fiscal outturn for the first quarter also pointed to significant revenue shortfalls, although expenditures remain broadly within targets. It is important to note that government has put in place measures to address the revenue shortfalls and rationalize expenditures, including a freeze on new projects to help with the fiscal consolidation efforts. Also, government has initiated a program to restructure its debt by substituting the high-cost short-term debt with longer-term instruments. It is expected to help reduce the high interest payments. On assessment of risk to inflation and growth, the committee took note of the impact of the combined effects of the upward adjustment in petroleum prices and the high twin deficits of 2012, resulting in aggregate demand pressures. Food prices continue to pose significant near-term risk to inflation outlook. The inflation profile is therefore currently dislodged from trends over the recent past. The major upside risks to the inflation outlook are therefore the heightened inflation and exchange rate expectations, the lingering fiscal pressures, challenges in the energy sector, the effect of weakened commodity prices on the external sector, and the likelihood of full cost recovery in the energy sector. On the growth outlook, the committee noted risks emanating from lower commodity prices, energy sector challenges, weakened business and consumer confidence, and tightened credit stance. On the balance, the committee held the view that the risks to the inflation outlook were elevated and outweighed the risks to growth, and therefore decided to increase the policy rate from 15% to 16%. Now, some additional measures. In addition to the increase in the policy rate, the bank has recently introduced changes to its monetary policy operations. One, the bank realigned the policy corridor by widening the band. The reverse repo rate is now 200 basis points above the policy rate, while the repo rate is 100 basis points below it. The bank has also changed its mode of presence in the interbank market by introducing an informal standing facility to operationalize its policy decisions and enhance the transmission mechanism. This process will be formalized shortly. These changes have steered the interbank rate within the policy corridor. It is expected that as government restructures its debt and consolidates its fiscal operations, the treasury bill rates will also fall within the corridor. The policy measures introduced by the bank in May 2012 with regard to the cash reserve requirements, the net open position limits, and borrow balances will continue to be in place. The base rate formula will be for computing the base rate by the banks will be implemented by all banks with effect from 2nd July 2013 to ensure transparency in the pricing of credit in the banking system. The Bank of Ghana will continue to monitor developments and take appropriate measures to ensure that the price stability objective is attained. Thank you.